Canada's economy is already strained by inflation, tariffs, and a cost of living crunch. And now, housing is sliding into a deeper freeze. Condos are piling up unsold. CMHC says roughly 2,500 new condos sit empty in Metro Vancouver, double last year. In the GTA, real estate agents report incomes collapsing as listings stall and buyers disappear. This isn't a soft landing, it's a confidence breakdown. The numbers back it up. The national average sale price in October was just over $690,000, down 1.1% year over year, CREA. National sales fell more than 10% year over year, with weakness concentrated in Ontario and BC, and pressure in places like Calgary, while parts of Quebec, Saskatchewan, and Atlantic Canada are holding up better. After inflation, homeowners are losing roughly 6 to 7% of real value annually. Here's the tell. This slump deepened even after borrowing costs eased. If lower rates don't bring buyers back, the problem isn't just affordability, it's trust.
Canada's housing slump isn't one market, it's many, and they're in different stages of the cycle. But in the biggest ones, the recovery story is breaking. For people on the ground, the hit is brutal. Incomes that used to run $200,000, $300K are now closer to $50K. This market runs on fear, not formulas. Buyers believe time is on their side. 6 months brings discounts, a year brings leverage. That mindset kills urgency. And when urgency dies, price discovery doesn't crash, it suffocates. The condo market is being labeled a buyer's market, but there's a catch. There aren't many buyers. Demand is fading across investors and end users, while inventory keeps rising.
Active listings climb year after year. Months of supply creeps toward buyer control, and sellers hesitate instead of rushing. When supply rises while buyers step back, prices lose support without any dramatic panic. Homes just sit longer, sellers cut slowly, and buyers push harder. Every stale listing becomes proof that waiting works. The damage is already visible. A home east of Toronto bought in September 2024 for $2.3 million recordedly sold last month for about $1.22 million, a seven-figure drop after a power of sale. And fewer new listings doesn't mean strength, it signals fear. Sellers delay, backlogs build, and that pressure eventually forces deeper cuts. Distress is rising too.
Once borrowers fall behind, banks escalate after a few months toward power of sale or foreclosure, and these filings are said to be up sharply. For some owners, losing the home is no longer hypothetical. Toronto is the anchor. GTA sales hit a 5-month low, slipping even after seasonal adjustment, and year-over-year activity remains weak, despite borrowing costs sitting near their lowest levels since early 2022. If lower rates can't restart demand, that's not a recovery, that's a confidence problem. Even rentals are flashing the same signal. Landlords are offering move-in bonuses, and rents in parts of the city are down hundreds from a couple of years ago. The slowdown isn't loud, it's relentless.
Toronto's rental market has lost urgency. People aren't scrambling to lock down units within hours anymore, and prices are following. Toronto's home price index fell 0.4% in a month and sits nearly 6% lower year over year, a sign of sustained weakness in Canada's largest housing market. Toronto matters more than any other city because it sets the tone. Investors take cues from it. Banks model risk around it. Developers price projects off it. When transactions stall in Toronto, lending tightens nationwide, appraisals shrink, and capital pulls back. When Toronto bleeds, the rest of Canada freezes. And condos are the weak link.
They're the entry ramp for first-time buyers, the parking lot for investors, and the pre-sale engine for developers. When condos seize up, the whole housing ladder jams. That's exactly what's happening. In the Greater Toronto and Hamilton area, new condo sales fell to 316 units in Q3 2025, a 35-year low, down 54% year over year and 92% below the 10-year average. That's not a slowdown, it's demand evaporation. Listings are piling up and inventory is nearing 7 months,
levels not seen in roughly 2 decades. Units that used to move in days now sit for weeks because there simply aren't enough buyers. Vancouver is flashing the same warning. Roughly 2,500 newly built condos are sitting empty, double last year. And these aren't distressed properties. They're brand new units with no takers. With supply this high, buyers hunt for deals and sellers lose pricing power. Prices have already cracked. Toronto resale condo prices are now roughly 13–14% below the 2022 peak, with some sales closing hundreds of thousands below what owners paid. The most worrying part is that even after meaningful discounts, buyers still hesitate. When lower prices stop pulling demand forward, the problem isn't just affordability, it's confidence. Builders react early when demand turns, and construction data is sending mixed signals. National housing starts rose to about 254,000 SAR in November, up 9.4%, but October fell 17%, suggesting volatility more than strength. Regionally, it's uneven. Toronto starts down 11% year-over-year, Vancouver down 1%, while Montreal rose. That divergence doesn't scream recovery, it screams uncertainty. The most wild month-to-month swings in construction aren't a sign of strength. They're a sign that demand is unreliable. When builders go from plunges to spikes, it usually means they're reacting to noise, not confidence. New condo sales are hitting levels not seen in decades, with cancellations piling up. And BC down 0.2%. Builders are the last to cut, so when prices stop rising, it's a ceiling, not a victory. The pipeline is the real risk. Roughly 26,000 condos are scheduled to deliver in the GTA over the next 18 months, while absorption stays weak. That mismatch forces delays, conversions, and cancellations. Pre-sales miss targets, financing tightens, projects pause, and construction jobs follow the slowdown. At the same time, rents are easing, another hit to the investor case. Average one-bedroom condo rents are down in key cities. Toronto nearly 6% year-over-year, April, and Vancouver over 4%. In a higher-rate world, carrying a condo as a rental is less appealing, especially when rent growth stops doing the heavy lifting. The Bank of Canada can see the problem, and the messaging has turned unusually uncertain. With the policy rate at 2.25% in December, inflation near target, and growth weakening, the bank signaled flexibility, while admitting it wasn't clear whether the next move would be a cut or a hike. Markets hate that fog, and developers hate it even more. Here's the bigger tell. Rate cuts have already happened. Borrowing costs have stabilized, and demand stayed frozen. When housing ignores lower rates, the issue isn't just affordability math, it's belief. Buyers stop trusting future prices, and once that trust breaks, small policy tweaks, like minor stress test changes, don't bring urgency back. Now the squeeze is showing up at closing. Appraisals are falling, and lenders respond by requiring larger down payments when a property appraises below the purchase price. Pre-con buyers face funding gaps, deposits get trapped, and some walk away, eating six-figure losses rather than closing into instant negative equity. That's a quiet failure mode that doesn't always show up in sales data, but it adds real pressure to the system. Meanwhile, the demand engine, first-time buyers, sits in the danger zone. Housing demand increasingly depends on job security, not rates. Buyers aren't asking, what's the mortgage rate, as much as, will I still have my job next year? Layoffs, shrinking bonuses, and rising unemployment hit housing before defaults ever spike. First-time buyers, roughly half of demand, have the thinnest savings and the highest debt exposure, so they're the first to freeze. Rents falling is good news for tenants in an affordability crisis. Downtown Toronto's average one-bedroom is around $2,200, roughly $400 below the prior peak in October 2023. But it's also a signal that the housing machine is losing momentum from both sides, ownership and rentals. Toronto's new construction condo market is now dragging on the national picture. When only 30 new condos sell in a month, that isn't a dip, it's a demand vacuum, and it spills into every headline number Canada prints. This phase doesn't start with mass defaults, It starts with stress concentrating in the weakest cohorts. Early-stage delinquencies are rising among mortgages originated in 2022, especially in Ontario and BC. Those buyers entered at peak prices with thin buffers and little equity after prices softened. 30-day delinquencies matter because they show pressure before banks step in. One missed payment is the first crack, not the collapse. Vancouver shows the same fault line in pre-construction. Units pre-sold around $2,500 per square foot are now appraising closer to $1,900. That gap doesn't just hurt balance sheets, it scars investor psychology. When investors feel burned, they don't wait for a better entry, they stop playing. And when pre-con demand freezes, financing freezes with it.
Then comes the calendar shock most people are underpricing. Nearly 1/3 of Canadian mortgages reset in 2026, 5 years after the ultra-low 2021 era. Payment shock arrives regardless of price direction. Many borrowers masked higher rates using fixed payment variables and longer amortizations, meaning principal barely moved, and in some cases balances grew. When these loans reset, payments jump instantly, even if rates don't. At the same time, investor demand has lost its foundation. Rental tightness was the support beam, and it cracked. Vacancy is up, rent growth cooled, incentives returned, and higher carrying costs colliding with softer rents broke the math. Without rent growth, leverage turns toxic. Appreciation alone no longer justifies the risk. That shift creates a delayed supply wave. Rentals convert into resale listings once losses become real. Investors exit faster than owner-occupiers because there's no emotional anchor, just spreadsheets and stop-losses. More supply is arriving from purpose-built rentals, while demand is softening from multiple angles. Limits on international study permits, out-migration from Toronto toward cheaper regions, and job market uncertainty nudging renters into roommates, co-living, or moving back with family. Even where GTA rents eased, pressure is simply redistributing. Some areas outside the core are seeing firmer prices. The old story, that population growth guarantees endless housing demand, has started to fail in practice. New arrivals still need shelter, but many can't buy at today's entry costs, so purchases get delayed, downsized, or diverted into rentals. The permanent floor narrative doesn't disappear overnight. It just stops working when confidence breaks and affordability becomes a wall instead of a hurdle. International student inflows are being constrained by visa restrictions, and temporary workers are losing pathways. That matters because the marginal demand that once propped up condos, renters today, buyers tomorrow, just got thinner. In theory, end-user buyers could replace investors. In practice, many won't. An $800K condo that averages 650 square feet doesn't feel like value to people who actually plan to live there. Shoebox salt, it's a demand filter. The bigger problem is timing. The inflow story that justified pre-construction speculation weakened just as supply kept rising. Developers and investors priced projects on a simple assumption: Canada would absorb virtually any number of units through immigration-driven demand. Policy changes exposed how fragile that assumption was. Demand was never guaranteed, it was conditional. That's why the pre-con model is breaking. Many buyers weren't planning to own, they were planning to flip before closing. When appraisals come in below contract prices and financing gaps appear, the flip fantasy dies and cancellations rise. And with roughly 26,000 more condos expected to deliver in the GTA over the next 18 months, the pipeline keeps feeding pressure. Historically, Canada's housing system could survive downturns through regional rotation. One market cooled, another stayed hot, and capital moved. That shock absorber is failing. Weakness is showing up across major regions at the same time, so demand doesn't migrate, it pauses. Buyers wait. Investors step back. Liquidity dries up. That's how you get stagnation: low transaction volume, choppy price moves, and a market drifting without conviction. Policy fades into the background because rate cuts and stimulus don't restore belief. Time becomes the only adjustment mechanism. Expectations reset slowly. Risk tolerance contracts. People who are cash flow negative start asking a grim question:
keep bleeding monthly or sell and lock in the loss? The answer depends on leverage, especially whether the sale price clears the mortgage.